Oh, gee, that was quick. And we are live on AUS Property Investors. We bring the big names and we have the big fun. How you going, Steve? What's happening? And Nick?
I'm really good, man. How you doing?
Yeah. I'm pretty busy, as you know. I'm trying to grow a beard like Palise, and it's not working out, as you can see. It's a little disappointing. It might take me another couple of years, but that's okay. How about yourself, Nick? What's happening?
Yeah, good. Yeah, good. Thanks for having me on. Really pumped to discuss commercial property and commercial property finance with you.
Jeez, I just got a smile that, man. Like you're pumped to discuss commercial finance. Like, that'd be good. Like, it's the sort of thing we've had a lot of resi brokers on the show, and it's with commercial is that next level. Having sort of been in the broking game myself, you kind of on your resi broker, you don't do commercial, but you sort of like you'll take the deal when you're there. But when there's really those specialists who know what they're doing, it's so important to align yourself. So great to have somebody like yourself on. So just to summarize what we're going to be talking about, we're going to be talking about, I suppose, the different types of commercial finance and just giving an overview, because I think that's important so people can get the lay of the land, and because not a lot of people understand commercial finance. So it's great to have an expert on. And then we're going to talk to some deals, because I think who doesn't love talking deals? And we're going to go run around the grounds, how things are tracking in the finance and the commercial property space as well. So Joe likes me to do that sort of thing so people know what they're getting in for. So drop a comment and drop a like and all that stuff. And if you're watching on YouTube, do that thing as well, people, because we want to, YouTube's been pumping. I've been noticing we're getting, I think Joe's put some marketing on it or something. Who knows? But yeah, it's weird to have two guests this week, so I'm kind of hosting. So jump in, Palise, if I'm talking too much. But
I'll ask lots of questions. But you're right, Jeff. So the biggest thing I always get asked with commercial, first one is they always say it's riskier. The second one is they always talk about how you need a much bigger deposit. So it'd be good to unpack that with Nick today about what you actually do need to get finance.
Yeah. I think you've actually you can get 80% sort of deals these days, maybe even more. So
we'll find out in the next hour and a half.
Yeah, I'm excited. So quotes of the week.
You can definitely get 80% possible.
You're supposed to leave them hanging, but that's good. I love you. Just give it absolutely
hang around to find out how later.
Yeah, exactly. Here you go. Leave those breadcrumbs. So quotes of the week, gents. Who wants to go first? If you have one, Nick, or if you're on Palise, I can go. Or who wants to go first?
I'm happy to go. All right. Oh, Nick. There you go. You're on, Nick.
It's got to read it from the other screen. So it's from Albert Einstein. Compounding is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. So I thought it'll tie in good with commercial property.
Fantastic quote. I think Joe said that about 5 times. So it's you're in good company. But so Palise, you've got a feel good one, mate. We're not talking money.
Yeah, I've had a bit of a rough week. My mum passed away a week ago now and had a funeral estate. So little feel good one. Taylor Swift is the quote person. No matter what happens in life, be good to people. Being good to people is a wonderful legacy to leave behind. Simple, feel good, not property related. Be good to people, folks.
Yeah. But I like, yes, that's sorry to hear about that. I mean, I kind of we knew, but yeah, it's a tough week for you, man. But that quote reminds me of Tim Ferriss, and he says at the end of his interviews now these days on Tim Ferriss show, he says, "Be a little kinder than what something about being a little kinder than what you need to be or something." Because I just think that's the sort of thing. We're all sort of hustle and bustle trying to get ahead, and we lose sight of those little things that. I was chatting to an agent the other day, and she was like selling everything off as soon as it comes on, and she said to me, "Oh, look, I'm actually just picking up. I've jumped on Facebook Marketplace, and there's somebody who needs sort of food because they've got a single mum, and she just was dropping out of the waters and grabbing some groceries." And I was like, "Wow, that's really good to hear. Like, good on you for doing that." And she wasn't kind of trying to big note herself, but I thought, "Wow, that's really cool that somebody's doing that." And I get a little skeptical sometimes of these things, but yeah, hopefully there's a good story. Yeah. Not of the agent, but of the person posting, because you just don't know these days. But I like to.
Yeah, there's nothing wrong with posting to get your own feel good. That's why people do it. People like feeling appreciated, so that's why I do it. I do find it weird the ones where they go up to homeless people and stick a camera in their face and like, "Oh, we're going to get you a haircut and give you some food," and that. Like, the last thing you want if you're a homeless person is a camera crew pointing out that you're homeless coming up to you. Like, just do it and be kind. Don't have to film it.
Yeah. Wow. Here we go. With this, I love these ones are going just
Sorry,
all
taking
sorts
on
of direction. No, I went there. So,
What's
so
your quote?
it's finance related. So if you would like to know the value of money, go and try and borrow some, which is by Ben Franklin. So it kind of reminds me of the best time to get finance is when you don't need it, kind of thing. Not that that's financial advice, folks, but yeah, it's interesting because you probably see this all the time, Nick. When people want to borrow money, they're trying hard and they just can't make it happen. But when banks are throwing money at you, you don't necessarily want it. But yeah, have you found that, Nick?
Definitely true. At the moment, there's more inquiries, more people wanting to borrow than 12 months ago when the rates were 0.1%. But it's a lot more difficult. So there was another quote I was going to say. It was actually never let a good crisis go to waste. And I think a lot of people are trying to take opportunity during this current crisis, but some people just can't. It's just hard to get finance.
Yeah,
I've actually seen, Jeff, the last few months, every time we had a rate rise, like a few months ago, everyone went, I might wait for the bottom of the market in a few months' time. Then it kind of stabilized a bit and everyone kind of jumped in. Then we have a recent rate rise and now the people are sitting on the fence again. I'm just like, you've obviously proven you can't pick the market. So why are you trying to?
Yeah, it's just interesting because people, like, even being the admin of the group, like you see so many people there. They're like, oh, what are people's thoughts on where rates are going and all this stuff? I'm like, well, they could go anywhere. I'm not saying they could go anywhere. Like 10% is probably ridiculous, but yeah, you just kind of figure out your own situation, and if the numbers stack and if the deal stacks, then what are you waiting for? Like, otherwise, when are you going to do it? You're going to wait till rates are at 2% again.
Yeah, and without bad-mouthing people, like there's like top-level actuaries that can't even work out where rates are going. So why do we think the everyday mum and dad armchair investor is going to have this secret like formula how the economy works? Like they're not. Like you just have to plan for the long term.
Yeah, exactly. Great. So what we're going to do, we're going to get into our first. It's not you, Palise, not yet. And then we'll introduce young Nick, and I'll introduce Palise again. I've got the standard thing that I roll out. I've even upgraded my I can do a video file now. So if we figured it out that I don't need to hold the mic there, and so it's all good, guys. I can do. We're now professional, moving into the 21st century.
I have no idea what you're talking about, but it sounds amazing.
Worse than going into a situation unprepared, especially when that situation is purchasing one of the most expensive assets of your life against a trained property expert in the form of a real estate agent. It's a scary thought, but it is a skill that can be taught. Do you want to learn how to become fully prepared when buying a property so you can get out there, buy your dream home or investment property without the fear of actually messing it up? Scott Agate, the founder and expert property negotiator at Hello House, has been helping people buy their properties by stepping in and negotiating with the agents and saving his clients tens of thousands and in some cases hundreds of thousands of dollars. Scott has now decided to share all that he's learned over the past 28 years in real estate so you can go out there and do the exact same thing on how to find a property, analyze that property, negotiate on that property, and transact on it to get the best results. He's created the Get Buyer Ready course, which is a step-by-step guide on how you too can become an expert property negotiator. It's the easy way of how you can avoid all of these agent games and get the best purchase price on that dream home or your investment property. The course is in short bites for busy people with no fluff at all. Just all the information you need to get buyer ready and secure that next property with confidence at the best price. Scott has been kind enough to give our community a massive discount with the link below. Sign up today before you even think about putting an offer on that next property, and it will be one of the best decisions you ever make.
There we go. I thought it was fairly seamless. I nearly perfected it, but anyway, that's fine. So, Nick, the person, I'll introduce you first because Please been on. I think this is his 4th or 5th time. So, good on him. He likes coming back for a chat. We'll keep having him back, I suppose. So, you've got over 14 years banking and finance. So, I just say over a decade because 14 years for me. I could probably say 13 years, but yeah. And over that, you've settled nearly. You've probably done it now. You've done close to $1 billion in lending opportunities. So you've done commercial, business, resi, construction, SMSF, asset finance. So is there anything you can't do? So you're passionate about property and helping your clients build wealth strategically. whilst also doing it in a sustainable and risk mitigated manner. But a question I didn't see any of this in your bio. What sort of things do you like doing in your spare time? Because yes, property is great, but what else do you like doing?
Well, I've got a young son, so most of my time at the moment now is occupied by my wife and young son, and we get out, go to the beach, do a bunch of things, go away. But yeah, property, to be honest, personally, property I was addicted to. I've pulled back now since we've had a young son. We haven't been active, but yeah, just spending time with the family, a bit of gym here and there.
Yeah. So I like to hear, mate, I like to live vicariously. My travel these days is done through Palise. So Palise, you've got to keep traveling, mate. Even you got a little bub come on.
I got bubs during the next couple of weeks. I won't be travel for a little bit.
At least, hold at least 2 or 3 days. Yeah, book a trip a week after.
I think it's worth pointing out as well. Nick's got a really, really impressive portfolio. I won't go into the details of it, obviously, but he's a self-married multi-millionaire.
Self-married? He married himself? No, self-made millionaire. Yeah. So, Palise, so you how many transactions have you done now? Because we've sort of said 1,000 plus properties.
I say 1,500. No, it'd be around 1,500. I'd say 1,500. Who knows if it's 1,300 and I've added a bit of fluff, or it's 1,600. I need to go back and calculate.
You haven't got it in a spreadsheet? I'm disappointed. Like, what are you doing yourself?
A big portion of them was on my previous company as well. So that one I have to go back through them. But previously we're doing about 300 a year, the previous company. And at the moment I'm doing about 10 to 15 on average a month. So yeah, we're getting up there after the 7-8 years now in the industry.
Great. Well, that's, we've got a lot of experience on board here. I feel like I've been dwarfed a little bit, but also excited because that's good. That's how we learn. We learn from people that have been there and done the hard yards. So, Nick, we love starting off people with their first kind of or their favorite property purchase. So, what is your property transactional purchase you want to tell us about today?
We'll talk about the one I did with Steve. It's 2021. We bought a little factory unit. I think it's about 200 square meter commercial factory unit in Kunda Park in Sunshine Coast. So it's middle of COVID. What was it? April 21 was COVID. It's hard to find a property. It was in super, and we had a bit of a timeline. I can't tell you why, but we just had a timeline. And it was hard market. Steve found a few properties. Kept on missing out on them, and my budget was it was 500. This was 4, and it was a fair bit less than my budget, but I thought, no, it's a good property, we'll buy it. So it's 400k factory unit, mezzanine. Tenants have been there for a couple of years, and the net rent was 23k at the time. So 2 years later, the tenants have just left last week. They've moved locations. It's currently on the market for $32,000 a year. So what's that? It's $9,000 increase in 2 years per year net. It's only been in the market like a week, or 2 weeks. So the agent reckons we'll get a tenant pretty quick. And we got it not revalued, but the agent gave me an appraisal. He reckons as an investment, it's probably worth $550. And then as an owner occupier, if I sell it to a trading business, it's probably worth up to 600k. So, cash on cash return in a 2-year period in super, I've pretty much doubled my cash that I've put into the deal. So it's a pretty good little factory that.
How much did you have to put into that one anyway?
We went 70% OVR, so 30%. So 120 plus stamps, probably 150. We probably have to cough up. So
I think the point worth noting, Jeff, as well, when we bought this property for Nick, people were saying it's the top of the market, being like, what are you doing? Market's going to crash. And what sells it for 600, bought for 400, that's 50% rise in a couple of years.
Yeah. I mean, I suppose if you sold it to an owner rock, like why is there that? I suppose because an owner rock values the values it more than somebody who's investor is purely just numbers driven, I imagine. Not the owner rock isn't.
Yeah, different markets it's the same as like residential. You've got markets where it's an investor-based market where it's like 70% of the purchaser are investors and they want a tenant in there on a long lease, and then 30% say, I think it's the same thing with commercial markets. There's little markets where basically the owner occupiers just can't get in, so they're willing to pay whatever. because for a business, they don't care if they're paying $550 or $650. They just want that space. They want somewhere secure to run their business. Whereas like investors, they want the yield. So the cap rate's going to be more important there. But either way, 550, 600 in the grand scheme of things is still a good return.
How good's this? Michael Shah. You're chatting to Michael tomorrow night.
Oh,
exciting times. Yeah. He's watching us. How good's that? We'd love to get Mike back on the live. So that it sounds like a really that's like a nice sort of relatively bread and butter type commercial. So was that was your first commercial, was it, Nick? Or
it's the second one. We own one in my wife. She bought one in 2014 in Sydney in Preston's. So it was her first. It's actually a funny story. Her first property she ever bought was a commercial property, which is
What did she decide? How did she sort of go out there and decide I'm going to buy a commercial? Was it because of business related, or what was the?
No, so her dad was a business owner and he's always wheeling and dealing and loves business and property. And he knew a guy, and the guy was I don't know, something. He was winding up his business, and it was just an off-market transaction. That one's a good story, but we'll be here for about 2 hours talking about that.
So you probably should be interviewing your wife then. From the sound, she sounds like the wheeler and dealer in the family.
Her dad really helped her with everything, like in terms of like negotiating and finding it. So she just had to get a loan.
Yeah, I reckon she did a good job though. Anyway, so onto we're going to talk a lot about that's. I feel we could just unpack. I feel Joe would want to ask a whole bunch of questions about that, but he's not here, so I'll run a relatively tight ship. But so let's go back to commercial finance. What is the difference between commercial versus resi? I suppose what are the major differences? So for somebody who's never got a commercial loan, it'd be great to talk to that.
Well, residential is just purely secured by residential property. It's the banks look at your income versus your expense. Commercial, some part of it is like that. So commercial finance is obviously it's against commercial property, but there's for investors, for owner occupiers, equipment finance is technically commercial lending. Development would fall under commercial lending. Super funds, and the typical property type would be factory units, factories, industrial, office, and retail, and then there's like a bunch of other specialized securities like childcare and petrol stations, boarding houses, a bunch of other things. But it's a little bit more unique where it can be property based, where the lending is specifically LVR driven on property, or policies are driven purely by the property alone. So it's a little bit more like residential is very regulated, living expenses, how many dependents you have. Commercial is not quite like that. It's some of it is, but yeah, it's very different. And with today's climate, a lot of people are choosing the lease stock product we can go into, and that's just purely they don't even look at your income. They don't look at how many kids you have, what your living expenses are. It's purely based on the merit of the property. So
do we want to start out, Jeff, on doing the difference between the full doc loans? So say you've got like let's say $1 million residential property versus $1 million commercial, full documentation. What would be the process between each, Nick?
I like that. Yeah, let's go through that. Let's go through a spectrum of commercial finance.
So full document, every bank looks at it different. So in the home loan world, PAYG client, couple pay slips, self-employed, 2 years tax returns, financials, and you throw everything in the calculator and it shoots out a borrowing capacity. With commercial, there's a few different ways to look at it, but under a full doc assessment, there's some banks that honestly their product is just like a home loan. For example, ANZ, 30-year term, 5 years interest only, or principal and interest. They use a similar calculator. They look at your income exactly the same, and they give you a loan, and you just pay it off for the next 30 years.
Are the rates? Did I get that right? 30-year loan term with a major big bank commercial sort of side of things.
Yep.
Because I read the other day there was somebody, Palise, said they were picking out an old newsletter where you were getting a 2.5 or something with ANZ. But the commercial rate. No. But so now the commercial rates are probably around sort of a decent commercial rate around sort of 5.5%, is it, Nick?
No, just over 6 now. So I did an exercise yesterday. It's commercial pricing is based on the deal as well. So, the lenders will do a risk grade on the applicant, the property, and they've got a few systems that they use to figure out the cost of capital to do the deal. But just getting back to the full doc, with the full doc, it's exactly like a home loan with some lenders. Some lenders, it's similar to that, but they only offer a 2 or a 3 or a 5-year term. And then you would need to review that at the end of the period. And you also, it's purely based on the cost of capital is cheaper for 2, 3, and 5-year terms. At the moment, 2 is the sweet spot. And that's how the big guys, the big dogs of town who, own $50 million properties, they're borrowing on a 1, 2, 3, 4-year term. They're not borrowing on a 30-year term on a $50 million property. And with PAYG clients, it's similar. It's just Palise and Serviceability. What's interesting is what a lot of people don't know is self-employed clients. So if you're a self-employed client and you're doing a full doc application and we're relying on company income to service the debt, they actually need to take a guarantee from the business. So the borrower would be whoever the borrower is, a personal names or a trust or a company, but there would be a guarantee as part of the loan for that. And a lot of people don't know that. You need to get legal advice. And in loans over $1 million, some banks also require a GSA, it's a general security agreement. It used to be called a fixed and floating charge, which is it's a register on your company's credit file that bank is ranking number 1 as similar to a mortgage for any priorities for losses, and they control that entity. For example, if that person went bust, they sold the property. If the business has assets or vehicles or whatever, they've got the right over that. So for business owners, it is very different to PAYG clients.
Is it? And that's only with full doc loans, is it, or is that sort of for all?
That's with full doc loans when you're relying on company income to service the loans. And then there's also with commercial as well, there's annual reviews. So with all the major banks and your bigger tier banks, there's an annual review process as well. So I'll just really talk about property investing today because the trading business stuff is quite different. But as a property investor, if your loan was over $1 million, now it's 1.5. APRA has regulates, and the banks need to report to the regulators, about every loan, and they allocate how they do the cost of capital allocation. So the annual review is the bank would need to, at the end of every year, get like a updated rental statements, lease, tax portals, to check the position of the client, financials for the business, if it's a trading business. And they do it's not a full assessment, but a little mini assessment to make sure that everything's trading profitably and positive. So it's very different to residential. Residential is you get your loan 30 years later, it's paid off.
As long as you keep paying it.
Yeah. Nick, say you've got a residential property, and when they do the servicing, they obviously slap on the extra interest rates. They do principal and interest. They shade the rent a little bit. So therefore, like most residential properties are negatively geared, and then that's where you run into servicing issues. Does that mean for commercial, because we're high cash flow, and I know the answer to this, because it's high cash flow, when you run that servicing, you might actually have a little bit more borrowing capacity with full doc?
It depends on the lender. So some lenders actually really buffer it. So they still use a 6.5% rate, 7% rate, but they use the net rent. They don't actually discount any of the rent. They look at the valuation, or they find the net rents, and then on the lease, and they use the net rent. So it can, depending on the LVR, and depending on where rates are sitting at the time, but it is possible. I've actually done some exotic deals where the client couldn't buy a residential property. I had to do an assessment, like an actual assessment an interest. So if you threw it into a residential calculator, it didn't work. But because I'm dealing with a business bank, we did a weird calculation where we'd look at the net rents, would see what that loan, the commercial loan, needs to service that loan, and any surplus income we then distributed to the individual as part of their home loan assessment. So it wasn't buffered. So because residential calculators and commercial calculators can be different as well. So some residential calculators will just buffer every loan. It doesn't matter if it's residential or commercial. So there's some really unique ways you can do it if you've got access to good bankers and good banks.
Yeah. And that's where I suppose the commercial finance is not a box square peg in a square hole kind of exercise. You've really got to and I suppose the thing I was thinking about there is at what sort of level can somebody get access to a business bank type relationship, or is it based on the relationship of the broker?
So commercial lending is always done by business bankers. So if you're an existing customer, you go into if you're a branch customer, walk into a branch, you say I want to do a commercial property purchase, they would say, okay, speak to our business bank, and it'll be the call center guys that are doing 50k overdrafts, cars on like a not low doc, but like a fast track policy. So they're not the right people to go to. I'm sure there's good people in those departments, but they're probably not the right people to go to. The broker market and the brokers who deal with commercial deals quite regularly, they've got access to the business bank. So it's like a backdoor in the banks, where every bank's got their own different business bank, and some banks there's a team that deals from up to $1 million, then a team above $1 million, then above $3 million. Some banks, just one banker can do everything up to $3 million. So it's like I'm lucky because I've been in the industry for a while. All my mates who I used to work with at St. George, they're all at different banks now. So we still keep in touch. They put me onto the good guys in the teams. I've got my go-to bankers, and it's really relationship based, and it's definitely not just like a home loan jumping and submitting it to a credit manager. There's always workshopping a deal up front, because you can massage deals purely based on all different factors, merit, LVR, serviceability. You can think outside the box on a lot of deals.
Yeah, and this is why, Jeff, a lot of people say their residential broker can do commercial finance, and they probably can. But do you want someone who's going to try to mash a deal together, not knowing what they're doing, or someone who runs on the board who can explore even just what Nick said? And we're going to go into like lease stock loans and all the other ones. So you do need someone who specializes in it.
Yeah, definitely. It's to get a commercial or a business banker to speak to when I was in that game, it's really they generally just don't want to, because it is a different type of skill set. You need to understand the way to structure a deal and put it together. And if you don't know how to do that, or if you're sort of just faking it till you're making it as a resi broker, you just won't even get them to return your calls, because they're wasting their time. They want a clean and well put together deal. So, and then once you can sort of show and demonstrate that, or if you got the relationship, then you'll get a go. But so let's once you've got the full
residential brokers, residential brokers refer me business, just like they pretty much say, my specialty is residential. If I do a commercial deal, I'm taking away from my day-to-day activity. I'd rather just refer it on to someone I know that will get it done, so they can focus on what they do.
And a lot of the time, Jeff, as well, they might have one contact at one bank, and who they're going to go with every single time without exploring the market. But it can change dramatically. I had a client probably 12 months ago now. Everyday residential broker said they can't get commercial finance. Then they went and actually spoke with a commercial broker, and they had about 2 mil capacity sitting there. So that's a big difference. When property's a game of finance, a spare 2 mil versus nothing is a huge difference.
I actually settled a deal last week for a client. So he bought a commercial property last year with his regular broker he deals with. He ended up having to buy it in cash. They just did a cash out of his resi. It was just too hard. And so he came to me thinking, okay, we've got, 8 weeks to settle. Can we get it done? And it was pushing me, but it was like saying, like, are you sure? Can we get it done? I've got the cash. I'll just buy it in cash. Got it approved, docs ready to settle with 4 weeks to go. And he was like, are you serious? Like, it's very easy if you have the right bankers and the right contacts and you just know where to go.
Yeah. You know the policy, and you know what sort of what the appetite is for certain assets as well for each. Yeah, interesting. So once we do full doc, where do we go for after full doc in commercial?
So lease doc it's a newish product with a lot of the banks. I actually know one of the guys who is one of my old analysts. He actually created the lease doc product at Westpac in St. George. But traditionally, banks have property investment sector policy. So it is lease doc, but they just didn't call it lease doc. And the lease doc product is more for the small SME market, small business. It's up to 3 mil, but some banks are moving up to 5 mil. But that, over 5 mil, it's pretty much that's how you do commercial lending for investment properties. So it's pretty much a standalone assessment of the property. So commercial property, usually a standard security, office, warehouse or retail, but then there's also specific policies for childcare and petrol stations, boarding houses. They've got their own individual policy, and then the LVR is different. But for lease doc, it's net rents, whatever the property provides in net rent, versus the interest expense, with I call it a buffer just to clients, but they assess it under an interest cover ratio. So it's, just to explain it easy, it's an interest cover ratio is 2 times interest cover or 1.5 times interest cover. So whatever the actual rate is, call it 5%. 2 times they're assessing it at, call it 10%. 1.5 times they're assessing it at 7.5%. So they use a buffer like that rather than like it's kind of similar, but instead of loading the rate, they do an interest cover ratio assessment. So the term of the loan is usually in line with the lease. So you probably need a lease that's 2 years or more to make it acceptable for most banks. But some banks, if you get a 5-year lease, you might only choose a 2 or a 3 year term just because of the cost of capital and the rates are cheaper. LVR policy-wise is some lenders go to 70%, some lenders go to 65%. But that doesn't mean you can actually get that. So what's happened now, since the rates have gone up, the serviceability is causing the net rent versus the interest. The interest has gone up, which has then brought down the loan amount in serviceability. So clients are telling me, the banks are toughening up. They've reduced their LVRs on lease doc. I go, no, they haven't actually. The interest rates have gone up and you don't service a 70% loan. So a year ago, any day of the week, any property, a 4% yielding property, 70%, easy, no problem. Now I base everything off a 6% net return when I give examples to people, because that's just what I see with people buying in cash flow areas. So at the moment, an achievable LVR is 60-ish. There's a few lenders that do it between 55 and 65%, but like call it 60% is where it sits on average.
Wow, that's and Steve, are you starting to see? Have you started to see people want higher yielding sort of assets to counteract lease stock, or does that actually help? Like, how do you?
Yes, and that's the reason they say they want a higher yielding asset. But 5 years ago, when I was buying at 7 and 8% net yields, they wanted 8 to 10% yields. They always want more than they can get. But like Nick said, it's getting harder for the lease stock, where you could buy like a 6-7% yielding one a few years ago, and interest rates were low. It was like you said, any day of the week you get in. Lease stocks are really attractive, easy to do. Now, like you said, I need to be buying at like 6% plus for it to even make sense for the broker to get the deal over the line.
Yeah. It's quite good, the product. I've personally done it. A lot of clients of mine have done it, but you need the cash. So you need the cash first to put into the deal. So today's climate, I've got a lot of residential clients come to me that bought, 5 properties, through buyers agents. They just kept buying properties, and they go, I don't know, people have read maybe Steve McKnight's book or some book, and they say, once you tap out with commercial, go to residential. Doesn't work like that anymore, because if you've got all this equity in your residential property and you want to go buy a commercial, but your serviceability doesn't work because your interest rates have gone up and you haven't done a loan since last year and you're already at your maximum borrowing capacity, you've got all this debt equity sitting in your commercial property you can't access. So the person wants to do they might have $1 million in equity, accessible equity, but they don't service it. So they can't do the lease doc, they can't do a full doc. I've seen a lot of clients at the moment, they're selling down properties that have they've got capital growth. They look at the portfolio and they say, well, I've made capital growth. The yield's not too good. Their interest rate's not too good. It's hurting the bank. I'm gonna sell that, cash out, and then roll that into a commercial property.
Which is exactly what I've done, Jeff. I've sold a few of my residential properties in Sydney where I feel like we're at pretty close to the top of the market and the yield's quite poor, and transition into that commercial just to beef up that passive income. But again, it's circumstantial. You got to look at what you're trying to achieve. I'm in the transition phase because I've got a big residential portfolio. If you're starting out, that's obviously not the strategy. But Nick, do you want to maybe go through what happens at the end of the lease stock loan? So say we get a 3-year lease, you get the 3-year lease stock loan. What happens at the end of the 3 years?
I should actually disclaimer everything I'm saying that this is not financial advice. You can contact me if you want to know more information and I can help you, but definitely this is just general chit chat. So
got the ACL, all that sort of stuff as well. Joe hasn't got his little cop disclaimer thing that he should send that to me so I can put it up on the screen.
So it is typically in normal environments, you get to the end of your commercial term, or before the end of your commercial term, your lease is up, or you've got a new lease. And if you're over $1 million, or now 1.5, you actually have annual reviews. So every year you're reviewing the loan anyway with the latest rental statement or the lease. So the lender would align the term of the loan with the lease. Some do it a little bit longer, just to screw it off to make it round numbers. Some do it a little bit less. They don't want to kick you out. That's not their goal. Their goal is to retain you as a client, but for the purpose of reporting and banking, they need to consistently do this. So at the end of the term or before the end of the term, if you've got 6 months out to the end of your term, you get or whenever your lease comes through, you then go back to the bank and then you review the loan. So you send your banker, who you would have a contact. If you've got a commercial loan, you'll always have a banker, or you go to your broker who will manage it for you, and you get your lease, and you then roll over the term for another period of time. Or there could be a better bank for you at the time who's offering better serviceability or better rates. So you could then refinance to another bank. Typically, with commercial, your rent does increase over time. In this current climate, the rate's higher. So the people that did a loan a few years ago, serviceability might be a little bit shaky. But like I said, the banks don't want to kick you out. They don't want to be on a current affair. They're just doing everything for reporting purpose. If you do get to the end of your term and you don't have a lease, they're not going to put you out. You'd go into a notice period where they work with you. They might extend your term for 6 months or a period of time. But yeah, they always want to work with you. They won't come in and sell it from underneath you. But what I always say to clients, buy a good quality asset. That's number one. Don't buy, I don't know, something in a mining town that, Chinese restaurant in mining town that might close next year, and you might have vacancy for 5 years. That's probably not the right property for lease stock. You want to have a really good quality property.
Yeah. What does
I was going to say, Jeff, one of the points that a lot of people get that fear that the bank's just going to take their property and sell it and get their money and run away. They do work with you. Obviously, you have to keep paying your mortgage. If you stop paying your mortgage, you're probably in trouble. But that's the same for residential as well. If you stop paying your residential mortgage, come after you. So that's the point. What I want to touch on,
It's not in the bank's best interest, pun intended, for them to do anything with that, because if they repossess the property or whatever they do, they don't have to. It's on their books. They have to sell it to somebody. So I have to figure out what they're going to do. So yeah, it's not in there.
If the client's paying their monthly like mortgage payment, if they're making money, they're happy. It's just sometimes banks just get a bit weird. They have got systems that alert annual reviews and reporting, and the bankers don't want to be in breach of their portfolio to manage the annual reviews. But like when I was working in the bank and as a broker, I've seen the banks, they want to work with you. They want your business. They want more business from you. I had some annual reviews recently. They failed the interest cover ratio test for banks. The banks are working with the clients. So yeah, they're not booting out anyone.
So Palise, what I was going to say, what sort of great deals are you? I kind of want to ask this first, actually. What sort of LVRs typically? Because I want to know what are they financing at 80% LVR? What type of assets? I know it's dependent on the deal. Does it have to be a super strong deal, I imagine, to get that 80% LVR?
No, I'll let Nick answer this, but it's going to come down to servicing.
So I can run you through the 80% products. So actually, I'll mention this, but then I'll talk about another type of finance as well. So there's one particular major bank, they go to 80% for loans up to $1 million. It's a tick and flip product, and that's for investors. So they can be PAYG or self-employed. As it's one of the only banks that allow 80% loan, but they cap it at $1 million loan. So you can buy a property, $1.25 million loan, 80%. I do a lot of them.
I imagine that has to be full doc. That definitely have to be full doc, wouldn't it?
Full doc, correct. For the self-employed component, there is a part of that policy where you can, it's like a BAS and self-declaration. So what I was alluding to before, self-employed people have a lot more levers to pull compared to a PAYG client. There's low doc, no doc. There's a lot of different things. But that particular bank, 80%, 1.25, they're the only PAYG 80% loan. They will move to 1.5 soon. And then for self-employed, there's other lenders that will do 80% for self-employed clients. There is one lender who will do 85% commercial loan, but it's for an owner-occupier commercial property. It's not for an investor. So they've all got their own niches. But like talking about the low doc as well, for self-employed clients, there's low doc products. There are 80% low doc products. There are 75% low doc products. The low doc product is mainly for a client who essentially hasn't done their tax returns, and this year they haven't lodged their tax returns, and this year's higher than the last year that they lodged, so that they're self-declaring that their income just because they haven't done their financials. That's really what the low doc product is for. It's not for getting, some dodgy accountant to say you earn 10 times the amount of money that you did. That's not what it's for. As a broker, we've got to do our due diligence and make sure we actually verify in the background other sources of income, just to tick that off. But with self-employed clients, there's a few more levers to pull than a PAYG client.
Yeah. Wow, that's a and what sort of assets typically? So you're probably not going to get a petrol station 80% LVR, no. I'd imagine.
Yeah, banks call it standard commercial security, office, warehouse, industrial. Most major banks really they're pretty good with location. So like I know most people, especially through buyers agents, they buy within an hour of a CBD or a major metro area. So they're fine, but some major banks will go to 80% in a regional town. So yeah, it's as long as it's a standard security.
They're basically trying to assess risk, Jeff. Like it's like as when you're buying yourself, you don't want to go buy a property that's going to sit there vacant for 10 years. And then same things like petrol stations. Obviously, if that closes down, it's not a 1-2 month vacancy period like a warehouse in the capital city. that's going to be vacant for a very long time. There's environmental factors where you'd have to infill it in, get it all signed off and things like that. And then, like Nick mentioned, specialized ones as well. Childcare, people love childcare, but there's actually a lot of risk with it that they're not aware of. Then special ones like car washes, cinemas, stuff like that. Anything that's slightly special that's not versatile, the banks are definitely going to have a look at.
They look at their exit position, like who could they sell it to? And like Steve said, a cinema, it's purpose built. A car wash is also purpose built, and there's there could be contamination because it's probably an old servo anyway. And same as service stations.
That was crazy how they're rebuilding IMAX again in Darling Harbour. Like, what's the go there? They knocked it down 5 years ago, whatever it was, or 6-7 years ago. Now they're rebuilding. Why did they knock it down? They should have just kept it. That's crazy. But anyway, I didn't even know it disappeared. I don't get out much these days. But so SMSFs. What are we sort of what's special? Or is there anything special around commercial finance and SMSF lending? What does that sort of look like?
It's pretty easy, super fun lending. It's probably the easiest of all lending. But with the higher interest rates, borrowing capacity is not as much as 12 months ago. So standard, the person, two PAYG clients, payslip, how much do you pay yourself super? You receive super, annualize that plus the rent equals how much you can borrow. So it's very simple. That's traditionally how all the lenders work, but there are some lenders where you could, if they want to buy a larger property, they can you can do an external serviceability. So you could say, okay, husband and wife are on 100K each. That's say $10,000 each in super, but they really need 20K each or 25K each. So you can do a serviceability assessment personally to say, okay, they've got that extra capacity to contribute more money. It's usually not so much because most people, when they're buying super, they've probably exhausted out their personal serviceability. As a PAYG client, self-employed, it's a little bit different because the self-employed business can actually rent from the super fund. So you can look at the whole business income and look at the rent that they were paying, add that back as non-recurring income. So there's a few more levers with self-employed clients as well. LVRs can go up to 80% commercial. I've never done one. The rates they start to get steep. And some lenders get a bit weird with locations, so at 80%. But its sweet spot, I see 70% or 65%. It's a tiered pricing, so depending on the client. I personally went 70, and traditionally most people go to P&I 30 years. You can do interest only, but most people just choose P&I. And no major bank plays in that space. It's all non-banks. So you actually need a broker to use these banks. The banks actually don't. A lot of these banks don't deal direct with clients.
Yeah. Nick, what interest rates are you seeing at the moment for self-managed super fund finance?
I think the last one I looked at the other day was about 7.5%. I think. So I think it was 7.5%. And then there's establishment fees, monthly fees, valuation fees. So it costs a bit of money, but once you do it, 30-year terms, no annual review. These are like home loans. It's purely 30 years P&I paid off the next 30 years. You can't. There is one lender that does offset for commercial and an 80% loan. It's pretty weird, but it's a very good product.
I think I might know that lender actually.
Yeah, like you mentioned, Nick, as well. Most people have a pay down strategy for their self-managed super fund as well, and then there's some tax advantages as well. You can do additional contributions to save on tax. So most people's goal is to pay that off as quick as possible, and then just have the income generating for itself there.
Yeah. Some people, they want to buy another property, so that's where the offset works. It doesn't mean it's the best product in market. So most people actually choose the lenders without offset, but there is no redraw. So once you pay your loan, you can't go in and redraw it back out. And when you refinance, you can't You can refinance a super fund loan. It's a bit of a pain. You've got to get all your documents from when you did it originally and trust deeds and all that legal advice, but you can't increase your loan. So you can refinance it and like round it up to cover fees and charges, but you can't pay it back. So I always say to my clients, what's your long-term goal? Do you want to buy another property or do you want to just pay it down? Because if you want to buy another property, just be mindful you can't money into the loan because you can't get it back out. So that's the offset product can work quite well. But yeah.
You touched on a couple of points there, so I'll jump in, Jeff. Valuations and establishment fees and things like that, because that's obviously different with residential. Do you want to go through those as well?
So valuations are mainly paid by the client for all commercial transactions. Sometimes they'll run a promotion and they want to get business covered, but mainly the client pays for it. They vary. So Sydney, quite expensive. It's doing one right now. Preston's Western Sydney for a client, $2,500. But I'm doing one in Queensland, $1,300. So it does vary. Sometimes in Sydney they charge a premium, and it can be property like type, if it's a single asset, or if there's multiple assets in the block. I've seen valuations of $20,000. And then establishment fee, it's a percent of the loan amount. So it depends on the lender. It can range from 0.9%, if for super, to 1.5%. Outside of super, the establishment fees range from 0.25% to 1%, but on average it's about 0.5%. There are some lenders that they're running promotions and they say no establishment fee, but what that actually means, they'll just lower the rate a little bit. So when someone gets a free in a commercial bank, they have a pricing tool. They put the property in, they put the term, and they seek a return, and it has to be approved by the pricing team. So a lot of the banks are not just waiving the establishment fee. They're waiving the establishment fee, but they're not giving you the best rate. So sometimes it's better paying the establishment fee one-off and getting a better rate for the life of the loan.
Yeah, I get a lot of clients, Jeff, who all of a sudden they see the establishment fee and they kind of kick up a bit of a stink, like, oh, I didn't budget that $5-10 grand. So you do have to take that cost into account.
Yeah, I love that we're seeing the raw kind of information here. We're not seeing the rosy, like, let's go and buy like 15 commercials in the next 5 years and get a fancy calculator spreadsheet thing that's going to. Sorry, Palise, but I couldn't help myself. But it's good to hear the sort of the on the ground sort of insights, and then you can like as you said before the live, sort of crushes your dream selling a little bit, Palise. But I don't know why you wanted Nick to come on, but this is an interesting one because I didn't think about this, because typically in a residential it's 80% LVR. They sort of start charging LMI. Like what's the go with commercial and LMI? Is there LMI in commercial? Or
no LMI. So with major banks, the way it works is in their risk rating model, they've got a few like risk rating benchmarks. So usually if on an 80% product, you pay a little bit more. In some banks, they call it partially secured. So it's fully secured up to 65 or 70%, and then up to 80%. It's the risk rate requires a little bit more of a high interest rate sometimes. But for example, that product 80% at $1 million, it's pretty much the same as other banks at 65, 70%. So it just depends. There is no LMI.
It's just reflected in the risk and that'll reflect the rate as well.
Well, it's also why you can't get 90% loans, Jeff. So most LMIs, because people are going to 85, 90, 95% loans with residential, you can't do that with commercial.
Yeah. Let's see. Somebody said, this is an interesting one. It's a bit detailed in the sense, or a bit sort of micro. Somebody said, when buying commercial property with an SMSF, why do some lenders want full history and docs while some keep it contained just in the SMSF? Is that because of their risk appetite? Like, what is the reason why their policy, or is it the borrower type, or what's the?
Oh, it depends. So if they want to see a full history of like your income, your employment, because that's how you get paid your super. So I'm just talking purely based on existing, so brand new super funds that are set up, and then now you're showing serviceability from you personally through your retail super contributions to buy in the super fund. Some lenders, you still need to provide like an asset and liability position, your full details, financials. Yeah, you need to still provide it all, but in the background, they're only just looking at one calculator that looks at super plus rent and the loan. Unless you, like I mentioned in the example before, that you need to do a bit of an exotic serviceability assessment to take out some extra serviceability to add to super, and that's what's a full assessment.
Yeah, great. Before we have we like, there's so much we could continue to cover for commercial finance. Is there any absolutely sort of really blaring sort of things that we should cover off? Because I really want to hear about deals too, Palise. So I love talking finance, and I also love buying deals. So you've got a couple you've read, but is there anything, Nick, that, or even Palise, jump in, ask the question that we should be asking about commercial property finance? What should we be looking at and thinking about?
There was one thing I should.
Carry on, Nick.
Sorry, there was one thing I was about to say as well before when we were talking about super funds. It's actually, so before, refinancing was a nightmare, and there are some banks now that it's called a fast track refinance. So it's pretty much, they look at your current repayment versus like, and then the rent. So if your rent covers the repayment, it's approved. Like it's as simple as that. So with commercial, there's so many different ins and outs of policy inside super and outside super that people don't even know about, just because not many people talk about commercial compared to residential.
And not many people have the depth of knowledge that somebody like yourself and has the sort of lending contacts. Because I think, as I said a couple of times, it's a lot to do with the relationships, because if you have those, then you may be able to get a deal across the line that another broker may not be able to, because they don't know how to workshop the deal.
And that's the thing. Every deal's different. Everyone's financial situation, property, everything is like, every deal you do, it's not the same. So like with like first homeowner stuff, two husband wife PAYG buying their first home, you can replicate that, and there's a lot of those scenarios out there for brokers that do it. And probably not that good at two PAYGs buying their first home. My specialty is actually the complex residential and the complex self-employed and commercial. So
is it realistic to think that under $1 million commercial asset, provided it's like a warehouse or something, not a petrol station or a childcare, is it realistic to sort of see that somebody could get a 70% LVR loan these days, or is it a bit tough given the interest rates have gone up? You need to go to 60%. It
comes down to serviceability. So if they service it, we could get them 80%. It's no issue. If they don't, it's full doc basis. And then it's just, just whatever they can service. If they can service 80%, we can get it. Calculator is similar to residential. So the only issue is with commercial. It's not an issue, but it's actually a good thing. We don't get access to a lot of the major banks' commercial calculators as brokers. It's internally computer system that they use. The good thing is we package up a scenario, we send it to our favorite banker, they run their eyes over it, they do the numbers, they come back to us, and they say, yep, it's a deal. So with residential, you actually have to package the deal, send it straight to a credit assessor, and a good broker knows the deal will get approved. They're not just shooting and praying that it will get approved, but just the extra layer of workshopping with the banker. The banker, if there's any hairs or any needs a bit of a massage, if there's every situation is different, they can pick up the phone, have that to credit, come back and say, yep, after a discussion of just a scenario, we can do this. So you're not really letting down the client and sending them on a journey if you're having the right conversations and dealing with the right people up front.
That actually alludes well, Jeff, into another topic I want to talk about is pre-approvals, but I feel like you want to run an ad or something like that. So do you want to?
No, we can talk pre-approvals.
Yeah.
How long are we going to be talking for half an hour about pre-approvals? Or are we talking 50?
No, we'll get Nick to give us a summary of like what the difference. So everyone knows with residential, you go get a pre-approval. It gives you a magic number that you're allowed to spend to with some confidence. Nick, do you want to go on what the difference is with commercial and residential with pre-approvals?
Can I just take that up? And I want to hear your thoughts on resi pre-approvals. I'm not a huge. I mean, for me, I'm not saying to people go out tomorrow and not go and buy a property without a pre-approval, because that's a little bit reckless, maybe. But for me, I found that you have to have that conversation with the broker, understand what your capacity is. But I found pre-approvals, particularly if they're auto-assessed, you need to understand, well, has somebody looked at this pre-approval? If they haven't, then it's kind of not really worth the paper it's written on. So I would want to understand what I can borrow. But yeah, I don't know. I'm a bit controversial there, Nick, or what are your thoughts on resi pre-approvals first?
Some lenders do fully assess, some people, some don't. And it just really depends on the client.
It's a good answer.
Back yourself. I deal a lot with business banks, even for residential. So for self-employed clients, high net worth private banking clients as well, you get access to the banker and then you workshop the deal with them. You can do pre-approvals and it's a fully assessed pre-approval. But a good broker will manage the client, potentially get them to have finance clause if they've just gone to auction. But with the high interest rate environment, the goalpost you can see, it's always changing. So you need to keep close to your clients to make sure that you're allowed enough buffers. I still do pre-approvals with banks, but the right banks. But for commercial pre-approval, it's a weird one. It's purely property based. So there's no such thing as a lease stock pre-approval. You need the property, and we need to do the numbers. So I give examples. I always use a 6% net return as an example. I keep refreshing. I spoke to clients and I tell them to go away, find a property, present it to me. I'll run the numbers with multiple banks. I'll present you the current offers, and then you can buy from there. But I tell them, keep your range open. So if your budget's $1 million, maybe drop it a little bit and keep your range open. Because I've got clients, the budget was X a year ago, the rate just kept them missing out, and now their budget's like 70% of what they could have bought last year. Now they're annoyed because they wanted to buy $1 million property. Now they can only buy a $600,000 property. So and then for full doc, it's some lenders do it, some lenders don't, most don't. It's property based as well. It's definitely property based. That 80% at $1 million loan amount, 1.25 property you can buy. They do pre-approvals, but it's hard. They're like, are you sure the client's going to get 6%, return? When you're dealing with a banker down in Melbourne, because you need to deal with a banker from where the client lives with that particular bank. So I'm like, yeah, 6% net return. They're like, I've never seen that before. I'm like, well, you're in Melbourne, and it's like 4%.
You're Melbourne. Hey, isn't that funny that Nathan Smith bloke? I wonder if he's watching tonight. Yeah, because it's like, oh, what do you want to buy in Melbourne? Because
Jeff, Nick's made a really good point. I've had brokers where in the past they'll do like Nick said 4%, and they'll come back and say, oh, you can borrow 700,000. Then they go speak with Nick or another broker who says it does it based on 6%. And all of a sudden they've got $1 million. So the broker needs to know what you're buying, which is also hard as an investor because sometimes you don't know what you're buying. Because I'm more than happy to buy a McDonald's at 5%, whereas if I'm buying a little warehouse in Brisbane, I want 6%. So I still want to be able to look at both deals, and you need a broker that can look at both. Sometimes I'll even have to send a sample contract, even if we're not buying that property, to the broker, just so we can get a bit of a thumb sucker where the figure might be.
Have you bought a Macca's before, Palise? Or?
No, not on the. No, I've got a KFC and a Subway, not McDonald's yet.
KFC. I remember some companies advertising had KFC in it, I think, didn't they? I remember that one. Somebody had, yeah.
A lot of the deals come down to the valuation. So you can't actually approve or review a deal until you get the valuation, because the net rent could be inflated. So they'll adopt the market rent. You might have a lease that's 5 years old or 10 years old, and they've just done a handshake agreement of what's actually the increases every year. So the document that you're reading doesn't actually reflect the current rent, and agents lie and miss out on outgoings and stuff. So if you're saying, yep, it's net rent of X, and you get the valuation, and they're like, well, no, it's actually different, and you're really like tight in serviceability, the banks, they don't want to put themselves in a position where they've approved a loan and it actually falls short because of the information wasn't correct at the time.
One of the horrible things, Jeff, for Nick, is because people are looking at deals, every time they find a deal on Real Commercial, they go, oh, Nick, what about this one? What about this one? What about this one? And all that is sending is high-level information. So he's doing this analysis without even securing a property. So try not to do that, people. Try to at least have a chat with the agent and get a realistic price expectation and the likelihood that your offer might be accepted before you just kind of go down that rabbit hole. Waste too much of your own time and the broker's time.
Yeah, definitely. It's like when in resi, it happens a lot as well. They'll go to a person will go to one broker and say, oh, what's the best rate you can get me? And they'll go to 3 or 5 other brokers and ask the same question. What's the best rate you can get me? Well, it's like, well, you can Google that if you want. I mean, I don't see that I can give you a rate, but you may not be eligible to get that rate. So yeah.
So the good thing with residential, most people have a targeted area. So they're like, okay, I'm going to focus on these suburbs. And then they can kind of get a feel for, okay, this is where the price is going to be. This is what the rent's going to be. With commercial, you don't know if you're buying an 80 square meter warehouse or a 300 square meter, where you're buying, what the lease terms are, how long the lease is, what the yield is, where it is, if it's got mezzanine areas, et cetera, bank guarantees. So there's a few more moving parts with it.
Controversial opinion you just said there, Nick, as well, that agents don't tell the truth. Like they may massage the outgoings or the expenses. I mean,
not all agents, but I've seen deals where that's a good thing about buyers agents. They do a due diligence period. They absolutely review everything, which protects the client before they have committed. So they've signed the contract, the due diligence, and the finance. So if the due diligence fails, you bomb the deal. If the valuation fails, you walk out. So I've seen many times before where the net rent was not the net rent. Quite a few times. I'm sure Steve's seen it 100 times more than me.
Yeah, I've seen it all the time. Sometimes it's actually the opposite as well. Sometimes the net rent's much higher, but the agent doesn't even know because they're just presenting the information that got told originally. And there's been good rental increases, or they've behind closed doors up the rent for a reason, and you actually get a bigger return than expected.
Yeah, great. Well, let's shall we after this? I'd love to talk an actual couple of deals, and if we could get commentary from Nick, I don't know, would that be interesting? I reckon that'd be interesting. And throw your questions in as well, people. If you want to know about commercial finance, any aspect of it, we'll do our best to answer it. So while I'm going to start, so we've got the ad of the hour. We've got Palise coming up. This is why he comes on, so he can watch his own sponsor. So here we go.
The amazing thing with commercial property investing is that in most cases it's cash flow positive from day one, which means that you can drive those profits towards paying down the debt. There are instances with commercial property investing where you can actually have the property pay itself off over 10 years, which is absolutely crazy. With commercial property, you get massive net yields, so you can expect anywhere between 6 to 10%. And as we've seen in the current boom, these properties not only provide large cash flow, they do certainly grow wildly in value too. Now, with big rewards comes some risk, and this is why you should de-risk your investment as much as possible. And the way you do that is with expert due diligence. And this is why we highly recommend people hire professionals to help you along in your investing journey. Steve Palise of Palise Property is one such expert. Being a chartered mechanical and structural engineer in a past life, Steve draws on his analytical and mathematical skills to do that expert due diligence for you. With 6 years experience in the space, Steve has over 1,200 property transactions under his belt. He's the guy you want in your corner, crunching the numbers and finding the best properties in the best locations, along with ensuring that you avoid the mistakes. Steve has actually even written the book on commercial property investing in Australia, and not only is it a bestseller, I believe it to be the most comprehensive in commercial property investing on the market today. He's been generous enough to give us a massive discount for our audience of 50%. So use the code OZPROP, click the link below, get a copy today, and start learning and getting on your commercial property investing journey.
Here we are. So it's interesting that Joe says wild, like in 6 to 10%. Like, I don't know.
That was made a year ago when I first started sponsoring the group. And the book is also 100% off. So if you go use the code word OZPROP, it's a free book.
Oh, gee, Palise is giving it away, giving everything away. The kitchen sink it. Yeah. So, oh yeah. You haven't changed that back yet?
No, I don't think so. I'm too lazy.
I should get another one.
Doesn't matter. I can let everyone know books aren't a huge money maker for me. You like make a couple of dollars a book. You got to sell a lot of books to make good money. From there, it's just get the information out there. It just builds confidence because obviously I give all the information out there. There's no secrets in the book. You can look at my due diligence checklist and all that stuff. You can do it yourself if you need.
Yeah. So let's have you got a couple of deals that you're
I've chosen a bit of a variety as well. Let me just see if I can get this to present. All right. Screen.
While we're getting up, Nick, what are lenders' appetites? And I know it's case by case and all that sort of stuff, but typically, what do they think about office space? Are they is that really on the nose for as an asset class in commercial, or?
No, it's actually so office industrial is priority with the banks. They love it. Office is okay depending on the location. Retail, one particular major bank has, so when I was talking about the interest cover ratio before, offices and warehouses, 0.5 times the interest rate is how they assess it. With retail, 1.5 times. So it's 5% rate times by 1.5, 7.5. Some banks are 2 times the interest rate. And this is actual rate, interest only. So there's no P&I, and it's the physical rate. There's one particular bank, they've hit their major bank, hit their retail cap, or they just don't like it. You need to assess it at 3 times the rate. So if say the rate's 6% now, 3 times
18%.
6, that's the assessment rate. Your LVR is 30-40% if you're lucky. They've hit their cap, they don't want it. So,
yeah, crazy. So what are we looking at here, Lee?
They are the highest LVR.
So what was that, Nick?
So that same lender actually has the highest LVR for industrial. So they like industrial. They're open for business. They just don't want retail.
Does that change as often as it does for resi policy? Like when I was resi policy would change for lenders every week. Like how often are they changing their appetite for each asset class?
The asset class policies haven't changed too much. It's just in this high interest rate environment, the way they assess serviceability, it's because they use actual rates with the interest cover as the buffer. Some lenders have actually added a little bit of extra buffer just to combat these times. So that's why you've got to just be on the tools and just be dealing with the banks every month just to keep on top of it.
Due diligence report. What have we got here? What's this?
I've chosen a few examples because I want to get Nick's opinion on how the finance changes. So I've chosen like the big bopper one. This is like a 3.475, I think, mil one. Then I've got like a regional retail multi-tenancy one. And then I've got a couple stock standard warehouses at different price points. So Nick actually knows this one. I chose this one intentionally. So Nick actually did the finance on this property. It's just a big steel fabrication warehouse. You can see a lot of area to kind of use and do things with down the track. But the main thing for this one is just it's a really long lease. It's a good yield. It's in Sunshine Coast, which is some of the tightest vacancy rates in Australia as well. One thing to point out though, so Nick's seen this many times, just due diligence on a commercial where 93 pages long. Like that's the type of work you need to do on a commercial. It's not just, I'll check flood zones and easements. That's kind of it. So there's a bit kind of work to it. But basically there's a bit of a summary for it. So it's a 3,000 square meter site, 1,400 building area, plenty of car spots, plenty of kind of lay down areas, got mezzanines, got all that type of stuff. I'll show you a few photos there so you get a bit of an idea. but it's just a big fabricator. Kind of just a tick the box one, but it's a higher price point. So like I said, it's 3.475. Rent's 210 grand a year. So we're up a good, I think it was at 6.5% net yield. And then we actually had an extended settlement on this one. So it actually starts with a fresh 5-year lease as we settled on it last week. So Nick, do you want to maybe just give a quick overview from the finance side of things for this property?
It's funny, actually. You know how I said before the client who had a better experience with a broker last year, and he was just going to buy this outright because he didn't think he could get finance like in time. That's the client. We got finance approved in 4 weeks with 8-week settlement period, and yeah, this was done under a lease stock assessment because I can't really say too much about the client's personal situation for privacy purpose. But, quite a successful person. It's got a bunch of stuff going on in the background. To simplify it, we did a lease stock assessment and major bank and, offered the client a couple of different options. One was high LVR, one was...
Yeah, I was going to say, when you're spending, say, 2-3 mil plus, there are different lenders for that you typically go to versus the sub 1 mil, like we mentioned before.
Yeah, so that sub 1 mil with that particular bank, that's a pure team that they just pump that out all day. The other lenders, some other lenders have got the teams which just have a little bit a higher limit, 2 mil, 3 mil, and then the corporate banking or commercial banking starts with some banks at 2 or it starts at 3. So this is still within the SME segment. So put it to market. The client presented him with multiple options. One had a higher LVR, one had a little bit of a lower LVR, but 50K, 100K wasn't too much, but a much better rate. And the client picked that particular lender. It was a 2-year term, purely for cost of funds, serviceability, cost of funds rate. And yeah, it's a client was extremely happy.
Yeah. So this, Jeff, is just kind of a typical. It's a bigger cost, but I wanted Nick to kind of talk about one, he did the deal, but more kind of the higher price stuff if it changes anything. But yeah, it's just a big tick the box. Got some future value add opportunities. Got a really long lease. Good area with low vacancy rates. Just kind of tick the box. So there's that one. As always, do due diligence. You can download my due diligence checklist from my website for free. So interview the tenant as well and find out what their plans are. Obviously, do the comparable sales, comparable rentals, check the council approvals, insurances, check all lease review, contract review, find out the vacancy periods in the region for different size assets and things like that. So I'm just kind of quickly summarizing on this one. We don't have to do it on the other ones. Obviously, going through the comparables is the hardest part as an investor because it's not just look at a square meter rate. You need to look at what the lease terms are on each of the types of properties. So you can see here, like we obviously go on Core Logic and go through as much as we can. Then we go to the auction results. Then we find out what's currently selling on the market at the time. So we speak with agents. We speak with property managers. We try to get as much kind of comparable information as we can there. And just cross-check everything. So rentals, sales, vacancies. You can see here there's literally hundreds and hundreds of comparables we have to go through as opposed to residential where you can choose 5 or 6 applicable ones and that's enough. This one, there's a lot of work. So there's normally a couple days worth of work just really diving into the kind of comparable sales, as you can see. So there's that one. This one's a little bit more of an interesting one. So this one's actually in Devonport.
Just going back to that, do you present this to when you're workshopping the deal, or you just sort of use it as reference, Nick, or do you use that at all? These kind of reports.
You mean for the client or for the lender?
For the lender when you're sort of trying to get the deal across the line from a lending perspective.
I'll let Nick answer.
So this usually comes in later, and the due diligence usually comes in later in the piece while valuation. We use, so like, for example, on this deal before we've even ordered valuation or committed to the bank, Steve did a full like memorandum information about the property, cash flow, like more of a simplified due diligence just to present to the client, which then the client sent to me. I then I send that to the bank. Make it remove a few things. I send it to the bank pretty much and say, look, this is the deal. I think how good am I? Like, I'm the one that did it. It wasn't me. It was actually Steve. They can pretty much run the numbers straight away off the initial preparation. And then the valuation covers a lot of things, not as in depth as this, but this usually comes in like pretty much when the deal's getting approved anyway, so it's kind of a bit late in the piece.
Yeah, fair enough.
Yeah, the valuation's basically to protect the bank, so they're just looking at comparable sales and the risk rating for the actual commercial. So I've actually got a valuer as part of my team. So the valuer in my team actually does what the values of the bank is going to do, plus does the due diligence for here as well. So as you can see, quite a bit of work, 90 pages worth of stuff. And that's not even including like the Dropbox that you get. You'll have about a Dropbox with about 20 to 30 documents as well that you use to cross-check this information. All right, so that's one of the standard kind of big deals. This one's a bit, I chose this intentionally because it's a little bit more interesting because there's a few moving parts for Nick. So this is in Devonport in Tasmania. So regional, so the regional property. It's also retail, but there's 3 retails as part of it. So let's see if I can get the summary for it. 3 towers, decent leases, but obviously the issues that's going to be for Nick is it's regional. There's multiple tenancies as well. So how the banks kind of look at that, whether they combine them and things like that. But this is just you're mitigating the risk by getting the 3 tenants. So the vacancy periods are probably longer here. It's not like a warehouse where it might be 1 to 3 months. These retails sometimes 1 to 3 years vacancy. So you need to really assess the area, look at foot traffic, look at road traffic, look at exposure, try to find comparables. That's actually the hard thing because 1-2 blocks away is completely different foot traffic and a different vibe to the area. So a bit more of a thumb suck kind of analysis here for vacancy. But again, you try to do as much as you can. So there, like I said, deal here, I think we got this for $950. Let me just double check that. Yeah, $950K. I think it's about a 5.5%. Yeah, we got $950K, 5.3. Yeah, it's about 5.5% net yield. So obviously a lease stock's probably not applicable. But I'll get Nick's thoughts on how he treats multi-tenancy for one, and then secondly, regional properties if there's any differences there.
So multi-tenancies it's fine, no issue. Whoever the agent then would pass on to the buyer's agent and would look at the weighted average lease expiry period, and then the valuer would mention that in the lease. So they'll take that on an average as the term for a lease doc, and for a full doc. Some lenders need on a full doc like a 30-year term. Same type of thing. They want to. Some lenders, like I was saying before, they'll only do a 3 aligned to the term as well, purely being on a full doc basis at that 70% LVR, because it wouldn't service on a 70% LVR on a lease doc assessment. And then just to highlight that bank I mentioned before that does a $1 million loan, they actually allow a lease of 1 minimum. So if you're buying property and it's coming to the end of the lease, but there's significant upside of increasing the rent, or it's under rented and you're going to get an increase, it's actually a good value add by using that product. It's a 1-year lease, 30-year term loan. But if they'll do this, you have to workshop it. You'd speak to the bank and they'll let you know. We don't have tools as brokers to do a postcode search for commercial like residential.
Yeah, so this is one point as well, Jeff, is even though like rates are going up in terms of interest rates, rents are going up dramatically as well. So if you're say you bought a longer lease a few years ago on an industrial property, even though you might have had fixed, say, 3% rental increases on that, now you're getting to the end of the lease term, you might actually be bumping up your rent 15 to 30%. So that can somewhat cancel out the higher interest rates as well. Not completely in all circumstances, but it'll definitely help, especially with some valuations as well.
And that's what happened with my example of the super property that I mentioned earlier. Like it's gone up $9K in 2 years. So.
Yeah, so that's fine.
Just one of the comments is saying, is it my internet tonight, or is the live interview pausing regularly for us? So I think it might be your internet, unfortunately, Nick. I think I think Palise is pretty smooth and silky, and mine should be good. But yeah, that's okay. Look, the audio is still fantastic anyway.
If anyone's got any questions, literally just reach out to me, Nick, or Jeff, and ask. Like we're all active on social media, so just
probably
ask
Palise or Nick.
Yeah,
I might get to you.
Ask the question in the AUS Prop forum, tag us in, and we'll answer it there, and that way everyone can see the answer as well.
Yeah, love it. But this is an interesting one, isn't it? So what was the purchase? Oh, sorry, I missed the purchase price. So you had
950. So it was 950. So the yield's not the best, but we're getting 3 medical tenants. So by medical I mean it's like a physio, a massage, and a Pilates studio. So you're getting 3 in line. So we're slightly lower yield, which most retail typically is, but they're all good tenants on long leases. They've all got 3-year plus leases. We spoke with all the tenants. They're happy. Business is going well. They want to be there long term. So you're mitigating any kind of vacancy risk by having the 3 tenants, and for a good price as well. Sub million, 3 tenants. Even if you lose a tenant for a year, you're still getting a big portion of the rent come through. So
Palise, are you saying that if somebody came to you and wanted a 7% net yield, that you would sort of say that they're chasing the wrong thing? They're chasing cash flow for the wrong reason? Or what?
Yes and no. You can definitely buy 7% yielding properties. Most of the time, they're regional industrial. So you go to like the Rockhamptons and the Townsvilles and things like that. It's just the vacancy period that you need to balance. So like typically there, for instance, Rockhampton, you're probably looking at 1 to 3 year vacancy for an industrial property. Whereas, say, Brisbane, it's 1 to 3 months. So I'd argue that buying a 6% yielding one is much better in Brisbane than a 7% yielding one in Rockhampton, because you're going to get better rental increases because the property's in more demand, better capital growth, and lower periods of vacancy. So I'd argue your ROI is going to be much better long term. And as most residential investors know, if you can get capital growth as well, that's where you really maximize your returns. So there's nothing wrong with that. Funnily enough, in retail though, Jeff, some retail in regional areas is actually lower risk than capital cities, because if you buy on the main strip, there's no other main strips. That's where everyone walks down. The vacancies are stupidly tight. Like if you lose it, it might be vacant for 6 months, but then you get a tenant for the next 15 years. So you can get some really good, like reliable tenants in main strips in regional towns. But again, it's part of the due diligence. It's sending someone on the ground to look at the foot traffic, different times of days, how much cars are going through, what future developments are going on as well. So make sure they're not building a Westfields 1 street away or a couple of streets away that's going to destroy your foot traffic. So you've got to look at all that. Retail, it is a lot harder to get right. So don't just jump into it. If you're a first-time investor, I'd probably suggest kind of industrial, just because you get a bit more like for like. Like you can look at square meter rates. You don't have to worry about foot traffic and business success and all that type of stuff.
Yeah. And what's been your, like you've done a lot of commercial deals, commercial loans, Nick. What's sort of been the better investors, and better is a relative super subjective term. What are you sort of finding that the better investors are focusing on when they're with their commercial investing?
It really depends. Like retail, I've seen clients with $150 million, all they own is retail. I've seen a client, like a family office, they've got $1 billion under management, in assets, pure retail. But the standard, normal, high net worth like that, I see a lot of industrial. Like most deals I do are industrial. Banks love it.
Yeah, Jeff, a lot of my clients that own primarily retail, they got started because they owned a retail business initially. So they might have owned a cafe, or I've got a client who owned a bakery. They've bought that, and then they've obviously done really well in business, said, oh, let's buy another retail property instead. And they kind of go down that hole. But again, that's because they generally understand it. So that's their niche. The same as there's people that do duplex developments, people that do boarding houses, people that do renos, people that just buy the stock standard kind of 3-4 bedroom houses. So find a bit of a niche as well and become a master at it, at least at the start, and then you can diversify when you've got less risk.
Yeah. Before we get onto the... Oh, sorry, yeah.
It's funny. A lot of the the Greeks and the Italians. They came to Australia in the 60s. They had a fruit shop or a deli or something. I've seen families like that are worth 150 mil purely by buying just retail for 50 years. And it's just that's compounding. Some of them probably don't even know what they're doing in terms of they just do property. It's going to go good in time. A lot of them, I've seen the whales and the leases on it. Some of them are pretty average, but they've owned them for 50 years. So that's just the power of the compounding.
And they just understand, I suppose, the business aspect of it. So they're running and focusing on running a successful or managing the successful business rather than, yes, it's sort of ticking over the investment in the background as well.
But as Nick said, Jeff, it's compounding. It's long time. If you bought anything 20 years ago, like we're arguing about the difference between a 5.5% and a 7% net yield now, you bought something even say 10 years ago and you bought it at 7-8%. That's now probably generating about 15 to 20% return. And that's the main thing. And you get that compound growth. You don't have to buy the best buy every time. And I get a lot of people that try to scrimp. And we had this actually discussion this morning where everyone worries about 10 grand here and there, but I would much rather buy a better quality asset and pay market price, knowing that I'm always going to have a tenant, going to get capital growth. It's going to go perform really well, as opposed to just chasing that below market value. And that's the only criteria.
Yeah.
I tell my clients right now that we're at a point in time, like they look at a deal and they go, oh, it's all right. And I said, well, we're at a point in time. Commercial, your 3%, 4% increases every year. You might get a CPI increase like we have now. You might go up, 7%. You've got to look at it in 3, 5, 10 years. And, using a buyer's agent, you pay a fee for it. But you're paying for protection, the due diligence report, the sourcing, and just the peace of mind. So, paying, whatever it is for a buyer's agent fee. Residential, you're paying a buyer's agent to get you an under market valued property, and you might pull out equity in a year's time and go again. For commercial, you're paying for the experience and like the experts who do this daily. Because I've seen people buy themselves, and I've seen valuations coming back not too good, and other things yeah.
And one point to note as well is you don't have to trust your buyer's agent. Like especially with my clients, I give them all the information. Like you can cross-check this as much as you want, ask as many questions. If you're not happy, even if the buyer's agent's trying to push you into a deal, being like, buy it, it's a great deal, you can still say no. Like it's your money, it's your risk. They're going to give you the information. You need to feel comfortable. Obviously, there's always going to be fear. Like I still get scared every time I buy a property thinking, oh, have I cross-checked everything? Have I got everything right? Is this the right property at this right time? Like that's a normal thing. That's what protects you. But you can cross-check all the information. You don't have to trust buyer's agents.
Yeah, depending on who you speak to, some people trust buyer's agents less than others. But yeah, anyway, this is an interesting one. How do you do due diligence on a new tenant with a good work history starting their own business? Is that too much and wants to lease your property? Is that too much of a risk, Palise, or what do you? And even
we'll go through this one, and then I'll come back and jump into the chat, and we'll go through that. That way, we're kind of done. Okay. We can answer
throw your questions in, people. Like make them hard, because I want to see Palise's his hair's too neat. It needs to be needs to make him sweat. Even so, and Nick, give Nick some easy questions.
Yeah. All right. So I've chosen this one. It's just a little stock standard warehouse. So as opposed to the big bopper that we showed you before, this is just a little 490K. So sub half mil, just another little tick the box type warehouse, WA in Frosdale. So southern parts of Perth. There it is there. It's just big roller door, fits the bill, still got the office space and the mezzanine inside. I think we got about a 6% net yield. I can't remember from memory. About a 6% yield. So 29 grand rent, bought it for 490. So what I want to show Nick for this and the view, when people say commercial's unaffordable, you can buy affordable commercial. You can buy these little kind of cheap ones that tick along. The negative with the smaller ones is don't expect to buy a $500,000 property with 5 by 5 year leases. Like most of the time, the tenant's going to be a slightly smaller one, probably more volatile as well. So what I mean by that is because most small businesses go one or two ways, they're either going to grow and outgrow the space, or they're going to close up shop. So you probably expect on something like this to get a new tenant every 5-6 years, but the vacancy rates in these regions are quite small. Like I said, 1 to 3 months, you get a new tenant. So every 5 to 10 years, you might get a new tenant, have a few months vacancy. It'll still tick along, still have the rental increases, basically hopefully get the capital growth as well. Not guaranteed, but hopefully get it. But yeah, just a nice little set and forget warehouse. Good for like a little self-managed super fund because it's slightly new, got some good depreciation. Just box type one.
What are your thoughts on while we're talking Perth, Palise? What are your thoughts on commercial property over in Perth at that sort of sub $1 million, where if the economy sort of, I won't say we'll take a nosedive, but over there. But what have you sort of seen? Because you've been buying commercial property for 10 years now. How long have you been buying it for?
Yeah, personally, 10 years. Professionally, 7 years.
Because what are you were you buying these properties over in Perth back in 2015, 2016? And what are you?
Yeah, we've probably been heavily investing there, like Brisbane, Perth, Adelaide, Canberra for quite some time, because the yields have always been kind of poorer in Sydney and Melbourne. However, when I say poorer, like 5 years ago, you could get a really good commercial property in Sydney for 5.5%, but we were buying at 7.5% in those areas. So it made more sense financially there. That'll slowly shift. What will happen is the prices will keep growing till the yields kind of not as attractive anymore. And then the rents will keep growing in Sydney and Melbourne, and those yields will come back from 3 to 4% up to the kind of 5.5, and then it'll go again. Same thing with residential. We see the cycles. We go from there. I still think there's some room to grow in those markets because we are seeing rental increases quite dramatically. Ideal situation for me, we see 20-30% rental increases over the next few years because of the demand. Vacancy rates all-time low, still dropping. Again, this is ideal situation. I'll give you the devil's advocate answer in a sec. Interest rates over the next few years stabilize or come down. And then that's where you'll get a high yielding asset because you'll buy something at, say, 6.5% now in Perth. The rent will go up 20-30%. The interest rates will come down, and that'll end up being a 7-8% net yielding kind of asset. So that's the crystal ball, sugar-coated answer. What you've got to be mindful of is if we do see a recession, rents stop or come down, or small businesses start to struggle a little bit, and you're not getting the same tenancy period, which means vacancy rates creep back up, and interest rates keep going up. So all of a sudden, you're buying this asset where you're not getting the rental increases, rents might drop, interest repayments become more. You've got to stress test your portfolio to handle that situation as well.
Yeah, interesting.
I don't think that'll do.
Nah, so I think it sort of did. I suppose I'm just thinking because there's that perception about Perth being, I suppose, a bit more cyclical, based on the resources sort of sector. And interesting part of
it is, well. But long term, most capital cities perform pretty much the same. They all get between kind of, and we can argue that we can cross the T's and dot the I's and split hairs, but like most of the time you'll get between 5.5 and 7% capital growth year on year. The art of investing is trying to obviously pick the market as best you can over the kind of short and medium term, because that lets you accumulate more properties now rather than later. But if you'd bought anything in Perth that was kind of blue chip 30 years ago, you've still done really well now.
Yeah, this is let's I'll throw this question out before I go back to Brian's question. This is Dermot. He said, "What if you get it wrong? How do you get out or bounce back after spending a lifetime savings?" I mean, I'll throw in a thought or two because this is a really interesting one. When you say spending a lifetime savings, I mean, if you're spending everything you have, I mean, maybe I've taken this question a bit too literally or a bit too liberally. But I think if you're putting that much money into a deal, I think you maybe need to take a step back and question if that's a deal that should be being done.
I think the point of the question, Jeff, is how do they make sure they don't make a mistake on number one? Because as I sort of mentioned as well, property number 2, number 3, number 4, pivot off that. There's no right answer. You've got to try to get it as right as best you can. I always tell people don't try to get rich on the first property. Like just buy the most boring property you can that ticks every single one of the AUS Prop fundamentals and then get that as the base. Because at least you know over the next 10 years you perform well. It's all the people that try to get rich quick. They try to do something fancy or a big development project and don't have the experience. Commercial comes with it more risk. Like you saw the due diligence reports, they're 90 pages long. Like there's a lot more things to get caught up on there. A lot more reward if you get it right, but there is one thing, and that's why most people start off with residential, because at least if you're buying a kind of a blue chip area, that's where you'll kind of protect yourself.
What are your thoughts on that, Nick, as well? Because I imagine you see people who they want to, you mentioned it before, they want to keep moving forward, but they just, for whatever reason, they can't get the finance out. But that's probably not the worst case scenario. But what do you see investors who they've just made a bit of a mistake with an investment? Like what happens if they get it wrong? They get stuck, I suppose.
I haven't seen too many. Like a lot of I don't get a lot of clients, mum and dad own their home, go just buy a commercial property themselves. It's quite rare. Most of the stuff I do is either the clients have come to me from a buyer's agent, they've approached, and the clients come to me, or a self-employed client. They're buying their business premises, or they're buying a commercial property. For some reason, a lot of like people in business, they're more exposed to that. They're already negotiating leases for where they've been, or I don't know, that they seem more popular buying commercial properties as well. But have I seen it wrong?
I'll kind of rephrase the question a little bit, Nick. Have you seen any kind of horror stories with the rising interest rates where people have gone back to refinance, don't have the servicing anymore, and then kind of become stuck that way?
I can tell you a horror story. A horror story I recently had. I'll be open. I went to the bank's name. So lease stock. Okay. So before lease stock became really big, I said to the lenders, what will happen if the client doesn't meet the annual review, if interest rates rise? Nothing. We'll just keep rolling it. We'll keep rolling it. And I deal with a particular bank. Annual review came. A banker in Sydney goes, yep, no worries, all good. Move it along. Queensland banker sent me an email because the bankers deal with that particular bank with where the property is located or the client's located. And I got an email to say the client needs to reduce the debt by, it's a large loan, a few $1 million. The client needs to reduce his debt by $300,000. Doesn't meet his yearly review. And I'm like, well, one person from one bank said something, and the other person for the exact same scenario, and push back, and it's fine. It's just the particular banker. I don't know why or how. It's just, and so if I was upfront with my client's jaw dropped. It's like, well, where am I going to get the money from? But it didn't happen. So that was a good thing.
Wow. Imagine getting that call. Like that would, I just feel like, what are we doing here? Because what if you don't reduce that, then I suppose they can put you into default. Is that what they would do, or they would sort of commence proceedings or something like that?
We're in unknown territory, and that's what I've always identified with the banks. What we do in these events before putting a client into a loan, they're all saying, no, we'll just move it along, and they did, and at the end of it, they did. But I don't know, this email, I was like, wow, but it's fine. It's no issue.
Probably spit your coffee out. You get that email. You're like, oh, geez, okay, yeah. I'll just go back to bed on that day.
And that lender's not in the market. That lender's not in the market anymore in lease stock. They went too hard, and then they're not lending too much at the moment. So I don't use them. So don't worry, any listeners who want to do a lease stock, they're not in the cards at the moment.
It is one of the risks, though, with going off the plan, say commercials and even residentials for that instance. If you get something that's going to settle in 18 months' time and you put your small deposit down and it rolls around 18 months' time and interest rates are higher, or the valuation comes in short as well, you can become really unstuck there because you're going to have to make up a big portion of the difference. And like Nick said, or forfeit the property. And then even then, be in negative equity position.
Actually, do you want me to tell you a horror story? It could have worked bad. It was actually my wife's property.
No.
Yeah. I'll tell you,
the Preston one or the?
Yeah. So bought it 2014, 420. A sale and lease back. The guy was going bust. I think he was, doing not criminal things, but he was. It
just wasn't going too well.
It wasn't going too well. His business wasn't going too well. Him personally, my father-in-law knew him. He was a nice guy. And so what happened? we heard, I think they were like, the door was like kicked in, and like there was like, what the hell happened? And I think police had to like storm the place one day because he was doing, I don't know, something in there, but they wouldn't tell us. So got the lease, 26K a year gross return as well. So like that particular lease was gross, not net, just how they bought it. So council rates, water rates and stuff. So it was only like 22K a year, 20K a year after all expenses. The loan was done through a particular bank. I didn't do the loan. It was done through my father-in-law. He had business banking contact. They did an 80% loan, but that lender doesn't do an 80% loan. So what they do, they thought outside the box, and they did an 80% loan, but they amortized. They did principal and interest payments from the 80 to 70
to reduce the LVR.
So the payments were like $4,000 a month. And the $3,500 to $4,000 a month as interest rates moved at the time. So interest rates were crazy. The repayments were crazy. My wife was quite young at the time. So, and then the tenant, the lease was 26K a year. So what's that? Call it just under 2K a month. So there's a fair bit of
difference between the interest.
Tenants stopped paying. Then he'll pay a large lump sum. So having the 2K a month cash flow negative, plus the tenant didn't pay, 3-year lease went at the end of it. I think she lost $20,000 out of pocket in rent. We actually had to get the sheriff to go in. The sheriff, they don't care. We went and changed the locks. We called the police and go, this guy is, he's not leaving. And it was a metal fabricator. So how are you going to get all of his crap out? It's machinery and all metal scraps. We went in, bust a locksmith, broke in, changed the lock. He was actually living in there at the time as well. We thought we were, we've done it. And it's like he broke back into metal fabricator. He knows how to bloody play with metal and open it. We finally got him out. He owed us 20K and put it on the market. Blessing. From 26K, we got 48K straight away. The market moved. It moved really well. That was 2017, 2018. So we held it for 4 years. That property now is worth $1.4 million, I reckon, getting 52K gross. So take out expenses. So a bad experience turned into a really good property. But, if you didn't have the cash to hold over that period of time, stuck. And we did lose other opportunities, with the negative cash flow. We didn't actually buy many properties for a couple. We didn't do anything for a couple of years, just because of that fact. But it turned around. Not every property that could be like that forever. So
yeah.
Well, we refinanced, so the repayments went from $4K a month to $1,500 a month. So the rental just skyrocketed, and then the repayments dropped. So the positive cash was too much cash. The tax position was actually was not good there.
Oh, you poor thing, Nick.
Not a bad problem to have, I think. It's interesting because there could even be people with the other sort of at the moment who've bought sort of 2020 when rates went all the way down to what commercial rates were still sort of mid twos, and they bought sort of properties. Maybe they paid a little bit too much or whatever. Their cap rate was too low, and next minute interest rates go up and the business doesn't go so well or whatever, then the property's not worth as much. So it's just interesting to sort of see. I mean, debunk if I've got that incorrect, Palise, but it's kind of just can go the other way.
It's no different to residential. You just got to set your buffers. The buffer for commercial is obviously the no rent coming in, whereas residential, that can still happen, but most of the time you're going to have a tenant within a week or two. Whereas residential, it's probably more the maintenance and the mortgage that you need to worry about as a buffer. If the roof collapses and you're up for 15, 20 grand, you've got to fix that. Or if interest rates go up. So there is slightly different things you've got to kind of risk mitigate.
Yeah. I wanted to get...
I've got a pretty messy story as well. But
he bought... stories, mate. Here we go.
He bought so I didn't do the loan. He came to me after this situation. But he bought a gym, let's call it in Queensland. It was a couple mil. It was pretty expensive. 70% LVR. I think he thinks there may have been some funny business between the agent and the tenant, may have prepared for this. So settles, tenant leaves. It's a gym, fully like not purpose-built gym, but it's a gym. And it's a retail gym. It's not like an industrial gym. The tenant, no tenant for 6 months. It's got a new tenant now. It's had to put in like interest rates started to skyrocket with no rent. Maybe it was 12 months with no tenant, and then he got a new tenant, and you've got to do incentive period for this type of property. So they have rent-free incentives, and the client has the new tenant, a new gym, and so he's taken a punt on the new gym, and I don't think they've even opened yet. So so. That's
I'd be reluctant to. I'm not saying gyms all the time are bad, but I just think like you just see the amount of gyms that are coming out these days, like Anytime Fitness, the Plus Fitness, all these sort of even there's just a lot of different franchises coming out, and you just think, isn't there a bit of a saturation? Not all of them. It depends on the area, but what are your thoughts on gyms? Just quickly, Palise, we'll start to wrap it up, everyone.
Yeah, it just depends. It's case by case. They are higher risk and they're more volatile businesses. Following on from Nick's, actually, we looked at one actually on the Sunshine Coast previously where they wouldn't sign the next lease, but they said they were going to sign the next lease. So even they wrote a letter of intent being like, we're going to sign it, please sign. Had all brand new equipment still in the boxes in the gym, being like, yep, we're about to do a big renovation. We're going to get that sorted, then sign a new lease. And something wasn't quite right. And then we saw like 3 months later, we didn't go ahead with the deal. They would moved out. They were just basically trying to lie to us to get the best price. Like Nick said, they probably had an affiliation with the seller somehow and was just promising, saying, oh, yeah, we'll stay on. But there was no guarantees, no bonds. The lease wasn't there. But I could see he could come unstuck. Good thing is, in that area, filled in a few months, Sunshine Coast is a really hot spot for retail at the moment, retail industrial. So not the end of the world if you had bought that property. But that's also why I always focus on the low vacancy rate regions. Like, the tighter the market, the less risk there is, even if the tenant's not great.
This one from Michael Shah. He said he'll be chatting tomorrow night, apparently. So he said, any guidelines for negotiating rent-free period, fit-out, etc.? Guessing very different for retail versus industrial. Yeah, what are your thoughts on that?
Yeah, so best thing to do is never reduce rent. Always give a rent-free period if you can, because obviously commercials get valued on the net yield and the cap rate of the area. So you don't want to reduce it by 10% and have a lower rent. Nick might be able to answer some ways that might actually add benefits for if you can still get the loan over the line, but always do the rent-free period. It's a case by case. Like if you retail, definitely you're going to give them a rent-free period if they're coming in doing a big expensive fit out, because the likelihood that new business have the cost to actually be able to do the fit out, plus pay the rent, plus start getting the clients in to make income is pretty slim. But the good thing is if they're spending 200, 300 grand fitting it out, they're not planning on leaving anytime soon. So the premise of that property is the success of the business. So you'll normally, if you want a guideline, typically kind of 3-4 months rent's a normal fair one for a retail. Industrial, pretty much never, unless they're going to build you a mezzanine area or something like that, because it's just some pallet racks. So they can come in and out within the day with some forklifts and dismantle that and come in. So there shouldn't be any real business interruption for them.
Yeah, there we go. Any thoughts to add on that one?
Just with the lenders, I've done a few lately with an incentive period. So the valuation will stack up usually as the annual rent, which is good. So you don't tank the valuation, but the lender may do an assessment and only use the net rent of that particular year for the assessment. But for example, if it's 3 months rent-free period, you start the application now. By the time you order the valuation, you sit around, you actually then submit the application. If you just wait a little bit, and so as the
rent-free period's over,
that's more of a refinance or existing property. But it's case by case. Every lender, you're dealing with commercial, you're dealing with a credit manager who has really got the right to do anything they want. Like they can bend the rules and make it better for us, or they could have their own personal opinion. And that's when we
I like to use the word discretion rather than break or bend the rules.
Like Nick said as well, it's normally for a refinance. There's not that many properties that come on the market where it's fresh lease, got to give incentive, and you buy it on that day. So it's normally a refinance period.
Yeah. No, in a refinance, you just sit around for a bit. Your audit valuation takes a few weeks, and by the time it settles, it's probably at the paying period, so it's fine.
Yeah. So I think we've spoken about this on another live. So maybe we should just Palise. What do you think? How long is it going to take you to wrap up with the benefit to invest in commercial already?
I'll answer my question in regards to the actual property and cash flow, and then I want Nick to actually answer for what's the benefit of commercial lending over residential, because there's obviously some difference there. Commercial is basically better serviceability from my side, better cash flow, get the same capital growth, so you win on more factors. However, not sugarcoating, higher risk, need to know what you're doing, and as we heard from some of Nick's horror stories, it can go wrong as well.
And also probably the LVR as well, I suppose, is not typically, you're not going to get a 90% lend in.
So when you're starting out, you've got more kind of borrowing capacity with residential, assuming you've got the serviceability, because I'd rather go buy 390% loans versus 170% commercial. But again, it's case by case. It depends where you're at with your portfolio. But I'll let Nick answer that part, because that's probably going to be the advantages and disadvantages of commercial lending over resi.
In terms of just like benefits, what I see, it's not even lending related. It's true net rent. Like your rent is your rent. Your tenant pays all the outgoings except for maybe the roller door and the aircon. Everything's paid for, and it compounds over time. You know, I own quite a few residential properties, and my inbox is going off always with, you know, this is broken, that's broken, you've got to fix this, you've got to do that. And then when I look at my rental statement at the end of every month, I'm like, I only got $50 for this month. Like, what the hell? Like, so the true net rent, you look at a lot of the most successful people, like ultra rich people, like they're not getting rich on residential properties. They own, you know, industrial sites, or they own commercial. So, you know, like Steve said, 90% loans to start out with when you've got less capital. But, you know, you read, for example, Steve McKnight's book, you buy residential, you sell down or get equity, and you buy commercial. And in commercial, when you're retired, you can get commercial. As long as you've got deposits, you can actually commercial lending at any time. You can be 100 years old and go to a lease stock. There's no issue. So the flexibility of commercial lending, if you're the right client, like if you've got 50K, it's pretty difficult. But if you've sold your business, sold down some properties, and you want to just really build a commercial portfolio, you can definitely keep going.
If you're listening to the podcast, we've had our first dog on the session. Like, what does he or she? I think it's probably a she.
This is Panda. She's a she. She was actually found as a puppy in a garbage bag in a bin in Greece. So she's a rescue. Oh, no. I dog sit on Wednesdays and Thursdays over here for some friends.
Oh, yeah, she looks very sweet, Panda. I reckon she's got some wisdom on commercial property. Looks like she's got it.
She has heard so many conversations on commercial. It's ridiculous.
Yeah, we are live people. That's sorry to interrupt, but I got a little distracted by the dog, the fluffy object. Yeah. So this is an interesting one, because we might finish off on this. If somebody's got a really burning question, drop it in. But what sort of discount typically do you? I mean, it of course depends on the asset type, Palise, but let's just say stock standard warehouse. What's in a fairly standard area? What discount would you typically want?
I really like this question. So if you go back to the start, Nick was actually saying in some areas the price is higher for a vacant property because a business wants to come in and move into it. But again, depends on what area you're buying in, whether it's investor focused or kind of own occupier. The big thing to point out when you're buying a vacant property is you need a much, much bigger kind of cash deposit, because you've got the deposit. I don't think you can get many 80% loans, can you, Nick? It's normally 70% as a minimum. Then you
can get an 80% loan, but the one thing I've got to point out, vacant properties, no major bank will take any estimated rental or rental appraisal or a valuer's rental estimate. If there's no rental income, there's no rental income used for serviceability. Some of the second tier lenders, when you get to those lenders, you can, but you're paying 9%. You're not paying 6%.
Yeah. So with the question, like that's the first thing is you need serviceability for it. For one, you're going to have GST on the purchase as well. So there's another 10% in addition to your deposit. So there's a lot of cash to get back in going. You can get the GST back though. So if it is an investor and you want to put a tenant in there, you'll get that back on your first BAS statement, etc. But there's a lot of cash to put in the game. Some areas, I'll agree, you can get a 5, maybe a 10% discount if you can, but you're going to need a spare few $100,000 to kind of get into that deal anyway.
Yeah, because I suppose if I'm the person owner of this commercial property, I'm like, well, yes, I might give you a bit of a discount, but if they don't need to sell, then I mean, I suppose not the ideal, but the easiest situation as a buyer is if there's a 50% or 60% LVR. Like, whereas if the owner of the property doesn't have any loan on it, then there's not really that much motivation for them to sell it, even if it is vacant.
It's not so much the motivation of if they're selling, it's just what the market's dictating. They're going to get the price. I know people have got all these little sleazy tactics of, I'm going to get off market, this, that. The market's the market. The sellers aren't idiots anymore. They're going to look at least one or two comparisons, and you're going to pay dictating based on the market.
Yeah. I think the beauty with, I mean, a lot of buyers don't just talk about sort of getting like cheap off markets, but I think the beauty in a really hot market with an off market opportunity, it's more about if it goes to market, it will sell for a lot more than what you could potentially pick it up for. So if you pay a fair price for it, but compared to what it might go for on the open market, so you still have to pay a good price for it, but it just means you're not paying 20, 30, 50, 100,000, whatever it is above what it would have sold for.
Most of the buyers agents that are buying below market value, they're buying in a softer market. That's why they're getting below market value. Good luck trying in a hot market to get below market value. You might think it's below market value, but unless you've got a dodgy relationship with the selling agent, why would they sell it to you below market value? There needs to be something wrong with the property, or you just get it at a good time of the year, good time in the market, and just pick up a good price.
A lot of those like residential under market value properties with the online valuations, the AVMs or desktops, it's a computer. So it's if you bought the property and 3 months later a physical person went into that property, they'll probably value it for what you bought it for because you bought it for that price. But the AVMs and the desktops, I don't know, sometimes the data you could just wing and get a good val. Like it's you could have the more average property in the suburb, and then they look at the median, and the median's probably a little bit better than the rust bucket that you bought. So you adopt that higher rent. I've done it before, and I'm sure that they were under market value, which they were. But like I've seen clients buy properties and the vals to come in. It's all desktop.
And with a desktop, from my understanding, is that if you're above 80%, typically the lender will want to send somebody out there anyway. Like to get one of those desktops, typically that needs to be at least below 80. And even then, there's no guarantee that they won't send somebody out there. Or is that what's?
No, some lenders would do 90% loans with majority
AVM?
of them. Yeah, AVM.
There you go.
The way that AVMs work as well, sometimes it's a range. So if you bought a property for 420, 3 months later you said 450, it would come back and say customer's estimate accepted. You actually open the valuation, it'll come back at 420. Because it's within a certain percent range, they just adopt what the customer's estimate was. So, yeah.
We shouldn't be talking because some banks might watch this and get onto it. But I mean, I suppose they know about it anyway.
Like if you put the customer, like you as a broker, you put the customer's estimate in. If the customer says it's worth that amount, you put that amount in. And but if an actual valuation, when you open the report, it comes in lower. The banks they have, it's their valuation. They're the one that's accepting it. So
yeah. Okay, well let's go over to somebody else. This is from Jeremy. He said, like I love that Jeremy, like he's a big supporter of you, Palise, and just a big supporter of us. So he's going to come on in the next month, and we had the budget last night. I don't know what was there anything exciting? I didn't really follow it, to be honest. Maybe it was Monday night. I don't know. It was one of the nights. I look really uninformed, but Palise, am I putting you on the spot by asking you what? It didn't sound like there was a little bit of affordable housing kind of considerations for, which is good, but yeah, what was in it for property investors? Are there much? Or?
I did not watch it at all. I had my mother's funeral, so definitely off the cards for me yesterday.
There you go. Mate, I was almost going to reach out and just say, do you want to reschedule? Because but I know you got the pub coming up as well.
Jeremy's actually where I get my information for that. He's a perfect source for summarizing all that. I just follow him on socials.
Yeah, even Michael Shah. It's some big plaudits coming in from a really great broker as well. He's got a cracking resi mostly portfolio, maybe some commercial from the sound that he's looking into. But yeah, okay, guys. Well,
a few weeks ago, actually, we had an awards night, and I sat next to him the whole night.
Yeah, he's like I really I spoke to Mike anyway. We could go on for hours. So before we wrap it up, as Joe likes to do, what's a sort of great way? What's a good way for people to reach out to you, Nick? And I'll ask you as well, Palise. People probably know, but Nick, where's the best place for people to reach you?
Just Google my name, and you'll probably find the website, or so bluecranecapital.com, and all my details are on there. Or if you're on LinkedIn, you can find my name, Nick Wilcox or Nicholas Wilcox. All my details are there. Send me a message. I've got a broker Instagram page. If that's your platform, you can send me a message there.
You on TikTok?
No, not on TikTok. No, I'm not one of those guys.
Who knows who's listening to it? Yeah, anyway, might go down that rabbit hole. But yeah, I've learned heaps, and just when I'm asking questions and kind of just like, I mean, no, Joe's not here, so I got the chance to ask the question. So I really enjoyed just learning a little bit about a lot about commercial, and sort of then the deals were really fantastic. So, Palise, where can people reach out to you if they don't already know?
Carrier Pigeon socials. Just send me a message on any of them. Just type in Steve Palise. I don't think there's too many of them, so yeah, just type in my name somewhere.
Nobody's tried to impersonate yet, or they can't grow the beard?
I actually had an Instagram fake account start up for Palise Property the other week and sending like Bitcoin stuff. Weird thing is they had just as many followers as me, so I'm just like, they're doing well.
That's when you know you made it, when you've got a fake account.
Yeah, I saw a mate the other day, and he was saying that he's getting, we'll finish it off. But no, yeah, that's fair enough. So Palise Property, reach out to him, and apparently you get a free book. You just got to pay shipping. I was going to say shippage, which is posting and shipping combined. But no, it's been an awesome session, gents. Thanks for jumping on, Nick, at sort of last this minute. It's sort of fun to get you on. So any last words of wisdom before we wrap it up?
No, just thanks for having me.
Wisdom.
Okay.
Let's go. There you go, Joe.
Yeah, go talk to a commercial broker, not a resi one.
Let's go and buy commercial property if it fits your thing. Yeah. Wrap it up.